you doing tonight? This is Joe. Can you hear my voice and see Doug's screen, not mine? Yes, yes. Oh, hello, David, Carl, everybody. Good, good, good. Craig, nice to see you, Tim. Tim and other Tim. Lou, what's up, buddy? Oh, Paul, thank you for asking. The doggy is going to be fine after several hours and many, many hundreds of dollars at the emergency vet. She's going to be fine. Her face she got bit on the snout. She looked like she was eating a football, poor thing. It's like 4 times as big as normal. I'm also happy to report that the snake that did this will not be recovering. So no more of that. Yes, exactly. Thank you, Lou. Anyhow, so I will shut up and turn it over to Dougie for the Master of Swinging for part 1 of 2 because he has so many words to get out. We wanted to make sure he had plenty of time for the Q&A so that everybody gets it. Steve feels this is a really important subject, so I will shut up. Doug, have a great session.
Awesome. Thank you, buddy, and good to hear about the pup. How are we doing, everyone? If you can hear my voice, just throw me a couple Y's. Awesome. Awesome. Okay. How's everyone doing tonight? I hope we're looking forward to some swing trading goodness. Before we get started, though, of course, you all know the process here. Just in case you were still wondering, know that nothing presented in this webinar or video presentation, whether vocally or visually, is to be taken as trading advice. Everything that I'm presenting, all the content, is simply for educational purposes only, and no representations being made that any of your accounts will or is likely to achieve profits and or loss similar to anything discussed in this webinar. Hopefully you will take all of this and go homework the heck out of it, because that's where the rubber meets the road, right, folks? Okay. To start off, this is obviously swing trading. 4.1. As Joe mentioned in the beginning, I was going to cover a rather wide-ranging topic tonight, but there was way too much, and one of the critiques that Steve had gotten was, you know, I tend to put way too much in one session, so we needed to break it up, which is fine by me. That's great, because one of the things that upset me about the first two is I knew I was combining about, 10 different presentations worth of material into 2 things, so I'm more than happy to do that. And of course, this is in the BTMM style, all right? That should go without saying, hopefully. First, a little house cleaning, and I wanted to clear up some misperceptions. The Homework Helper update, that's out. That's been out for a little while. The past couple weeks, I really refined it for those of you that are unaware. We got flashcard features, it's customizable, object styles, so you can, quick hotkey toggle between different styles and your rectangles and your ellipses if that's your kind of thing. Direct text insertion, for example, you could just control click on the chart as an example, or hit the 1 and click on the chart and insert level 1, level 2. It doesn't tell you what is level 1, level 2. There's nothing that can do that aside from yourself. It just puts the text on there. Pattern name insertion, various hard-right edge training tools, and there is video tutorials on the way. I know I've cleaned it up, but it's still very confusing to some people, and people learn better visually. Now, the fee is still the same: 1 year of level markup or 6 months of H4 market phase markup, which I discussed in my first 2 swing trading videos, with the peaks and the confluences and areas of interest labeled on the H1. As far as I'm concerned, it's a fairly good price, right? So just send those in. If you're wondering, the 1 year levels get sent to btmmstudygroup@gmail.com, and the 6 months of swing homework gets sent to btmmswing@gmail.com. Okay, I'm going to move the question box out of the way. There we go. It's kind of blocking some stuff. Always check with your doctor before trading, Doug. Thank you. Somebody said it was a great tool. I can't even see the name right now. Tim, awesome. Glad you like it. Quick note about the questions. I had an idea because people throw in comments. I'm not really going to be looking at the questions or answering the questions until the end. But I had an idea. If you're just commenting on something, just type your normal comments. But if it's an actual question, so when I'm scrolling back, I see the questions. Could you please put like a dash in front of it first, so I know like, okay, that's a question by easy visual, just a glance. I know, ooh, there's a question, so I don't have to read every single line as much as I'd like to. Okay. The previous swing homework, for those of you that did send it in, I told everybody do GBP and EURUSD 6 months. I got out the homework legend for the EURUSD. Instead of marking everybody's homework, I just did a legend. I marked up my own charts and sent it out. For the pound dollar, yeah, I know. It's been a little bit of a while, but things got in the way, working on the presentations, the live presentations, updating the homework helper, of course, personal responsibilities, and of course, my own trading and homework. Things just, got backed up. So I'm going to have that out to you by Saturday, I promise. A couple misperceptions, all right? I got a lot of great feedback about the last one. As Joe was saying, Steve got a lot of great feedback as well, and that's why we're breaking it up into extended presentations to really cover everything. But there were a couple of, frankly, quite confusing misperceptions that came my way. So here's a brief lesson on how to drive a presenter up a wall in 4 easy steps, okay? 1 is watch their presentation. 2, fall asleep and or apparently not pay attention to the actual words coming out of their mouths. Disregard the slides that are right in front of you and, hey, choose to make up your own reality. And 4, get all worked up and send in complaints that could have easily been eliminated had you not done steps 2 and 3. Okay, now most of you are awesome, you're fantastic, you appreciate stuff, you ask questions, but then there's other people, well, they take these steps. All right, and these are paraphrased, okay? Basically, I'm crazy, I can't read an H4 chart properly, what the heck are you talking about, what's hidden divergence, you're making this stuff up. I didn't go over the H4 charts last episode. I briefly, my teenager does all those, somebody says. I briefly touched on them at the very end in order to cover a question somebody asked, what is the hidden divergence? And that's really all I did for the H4 charts. I mainly went over the H1 charts, pretty much the entire lesson last time. All right, hidden divergence is a real thing. We'll cover it more in depth when we get into the trends. Okay, Google it. And it's, oddly enough, most of the time it's the people that actually never send in markup who want to complain. Okay. Another thing that was thrown was apparently people thought I said that you can trade for 30 pips off the H4, and that's insane, therefore I'm not listening to you. The fact is I never said that. In fact, last episode, and it's important that this gets cleared up, I showed everyone what to look for on the H1. Now that was it, all right? Aside from a brief mention at the end about the hidden divergence, which I already talked about, I never touched on the H4. I mean, I'm amazed that this is even an issue considering I spent the entire session showing flashcard sequences that were clearly H1 charts. Now what I said was, just to be clear, the patterns that I was showing are both available on the H1 and the H4, and that the only difference is in the scale or the size of the patterns. Now, H1 sets up over a couple of days to a week, H4 a week up to a couple of months, all right? Now, what I also said was that despite the primary focus of what I'm talking about being the topic of swing trading, for the people that simply trade the intraday due to, other obligations and whatnot, job, family, kids, this stuff can still be used by intraday traders. Simply to identify the solid peaks or the solid movers and shakers, all right? If you're trading intraday, are you not first supposed to know where your peak is? If you're trading intraday, okay, aren't you supposed to know your direction via the analysis of the H1, okay? So if you're supposed to know where your peak is, you're supposed to analyze your H1 and H4 in order to spot your peaks and get your direction, then you're supposed to trade away from the peak, right? So my showing you the various conditions, the confluence of events, AOIs, that's there to help you more confidently identify the prime peak formation setups, okay? So it's me saying you can use this stuff to better trade your intraday stuff, even if you're still only a 30 to 50 pip trader. All right. I don't know how that's considered, crazy, or take it as me saying enter on the H4 and book 30 pips, but the entire method is based on being able to identify your peak and trade away from it. Okay. A lot of people get lost in the minutia of M15, M5, M1, but whether you want to swing or whether you're sitting in front of your computer all through London, being able to identify a solid peak with a whole host of different confluences, it can't do anything other than benefit you. Okay? So I just wanted to touch on that because I don't want there to be any confusion about any of this, because otherwise I'm afraid people are going to miss out, and that would suck. And then they'll continue to complain and not see success, and no one wants that. Even if they are complaining, I don't want that. All right? So it is H4 time this week. All right? I mentioned in the first two videos about the market phases. And some people were a little bit confused. The people that sent in the homework, actually, you guys, even if you didn't get the Euro USD legend yet, most of you guys did pretty well. It's fairly straightforward as far as I'm concerned. But I know a lot of people try and transfer the H1 concept of the levels up to the H4, and I just look at it as slightly different. All right. So this is basically an H4 roadmap, and the idea is trend versus range bound. Okay. So tonight we're going to be talking about range bound. I need to take a sip of water here. Apologize about that. And why we're covering the range bound right now is because range bounds, before trend anyway, range bound is where we spend most of the time in the larger picture. You always hear that's ranging and inconsolidated where we spend most of our time. Okay, so if you can learn how to handle the range bound markets and to distinguish between the two, and know how to handle it, that's going to help you, I think, more immediately than just concentrating, well, how do I handle the trend? Okay, so let's look at the characteristics. First, we're going to take a look at price. And when I talk about price, I'm talking about the main chart, the top portion of the chart. So I'm including moving averages here. All right? You have the larger moving averages in close proximity and crossing over. And remember, this is H4, not talking about H1 right now. This is glancing at the H4, what do I see? So I take a look at the H4 chart. I see larger moving averages in close proximity and crossing over. The 13's already crossed the 50. The 50 and the 200 may be crossed over, or they may be getting close. The blueberry is in the picture, all right? Now, they tend to go in 250 to 500 pip ranges on most pairs, okay? Aussie and New Zealand, some of the smaller moving pairs, they tend to, sometimes they just don't quite make the 250, or they kind of work in the middle of the 250 pip range into the middle of the next 250 pip range, whereas you look at Euro and Pound and UJ and CAD, and a lot of times they work precisely between those quarter points, okay? And there's a lot of market makers working what I call 2TL. You'll see that on my charts a lot. And the reason I'm throwing out these abbreviations, once again, I know it confuses some people, but when you take a look at my homework, it's all on there, so I want you to know what you're looking at. So basically trap volume. They're constantly working the trap volume, your false breakouts, your volume bodies, which I'll get more into at a later time when we talk about trade management. All right. Second legs, of course. A couple weeks prior, you might have a first leg, it hit the quarter point, rejected off, and then it worked a larger structure, and it came back weeks later, and now you're getting a second leg. That's still trapped volume to the left, okay? And, of course, false peaks, we'll get into that. Now it also includes market makers working vital price points, the quarter points specifically, and the 50 above or 50 below the QP, below the quarter points, all right? And another characteristic is the creation of larger structures, okay? There are some subsets that I'll talk about of range bound, because sometimes range bound doesn't quite hold the level for, a month or so where you can really benefit from it. But if you recognize it as, oh, this is a larger structure, it's just coming up here, giving a small crossover, and then heading back down, you can trade in that direction of the same way as the market maker cycle. You're looking for your 3 up, 3 down, but basically you're looking for a visible structure where you can see, there's the big M, there's the big W, the middle's hitting the blueberry, they're trapping there for about a week, because don't forget, we're looking at the H4, much larger time frames. They're trapping there for a week or 2 weeks, and then they're heading back down. I see what they're doing, all right? But mainly I'm looking at the range bounds that hold for like a month or two or even more. That's what we're going to be looking at tonight. Now the TDI characteristics for range bound, all right? Now, I separated for obvious reasons, as you'll see. Market baseline crossing over the fixed 50, which is the midline, and not just crossing over it once, okay? The initial crossover on the H4 will indicate, things might be changing, okay? But like I said, it could be turning into a larger structure, or it could be going into consistent range bounds. But for consistent range bound, you're more often going to see the RSI ranging between 40 and 60 on the TDI. All right, and basically what that means is we don't have the 40 and 60 lines on the TDI, but it basically means the RSI is not quite hitting the extreme overbought or extreme oversold, which is the pink and the green lines up there at the top and the bottom. All right. We will be seeing the extremes at the bands, the upper and lower bands for a range bound. So when you get to the chart, cool. What's the price doing? Are the moving averages close together? What about the TDI? Awesome. I'm in range bound. All right. Now the bands, including the fixed 50, is also very important. Okay. Want you to remember that, write that down. The bands enclosing the fixed 50 is very important, because I think a lot of people, I know a lot of people, they don't pay attention to the bands unless, it's a shark fin. Okay, they don't really notice what the bands are doing. They're just like, is the RSI at the bands, or did it break the bands? No, then I really don't care. Okay, but in the range bound, you will see the bands will create sort of this pocket around the fixed 50, and that's what we're going to take a look at. All right. Now, I want you to understand, not just looking at the chart, okay, and going, all right, well, Doug said this and Steve said this, and this is what I'm looking for, but I want you to fully understand what range bound is telling you about the current system or the current sentiment of the market and how it's affecting people and the systems. So sentiment, basically that's the people, right? And then the systems, those are your robots, your algos, all that kind of stuff. The high-frequency traders, all right? So trader participation. Oops, I'm sorry. I didn't realize I still had the phone in my room. Trader participation. You have the mental and emotional states. We need to know what the retail traders are thinking out there, because what is the overarching goal of the market makers is to book a profit. It's all about the money, and they are trying to create a sentiment and then act against it. So Steve always talks about stop thinking like a retail trader. Well, I'd like you just for a second, when you're looking at this kind of stuff, to try and think like a retail trader, because the market makers know exactly how retail traders think. That's how they induce. So let's just for a moment change it to stop trading like a retail trader, but be able to think like one. All right? What are the mental and emotional states, the thinking and feeling, okay, that creates the beliefs in the retail traders during a range bound? Okay, so you get like, support and resistance, all right? Ooh, it broke out. This crossed over. Now we have momentum. My EMAs and my momentum indicators, the oscillators, they're switching over. They're rolling over. I'm getting signals, all right? And then, of course, ping-ponging price points. Ooh, it's rejecting it here. That feeds into everything, okay? That feeds into all of the above. Price points, it broke the 0-0. It bounced off the 50, so you got your supports, your breakouts, all that kind of stuff. Now, what about system activation? These are your technical states. We have the emotional states and the mental states of the retail traders, but we don't have that for the systems out there, the computers. That is the technical states. What kind of technical states are they creating in these computers? Steve always talked about how do they accomplish their goals. Of course, they induce traders, but they also validate the technicals. And they don't validate the technicals simply for, to monkey click that position, to go long, to go short, but they're also activating all the robots, all the systems out there via the moving average crossovers, the breakout signals, and of course the momentum oscillators firing over and over. It's pretty much the same thing, but you got to remember, a lot of times I notice in talking to people, they forget that there's massive amounts of money being thrown around out there via the robots and all that stuff. So let's go to the chart to take a look and see what's happening in a range-bound, a typical range-bound scenario. All right. So I'm going to follow the same path that I did last time. Just take a look at this just for a couple seconds, maybe 10, 15 seconds. I want you to just think perhaps what signals might be there with the stuff that we're using. Okay. So we throw in the quarter points. Now we can see, right, we'll get there. We can see that we're ranging in between this top quarter point and this top quarter point, okay, 250 to 500 pips, all right? Now, I know there's going to be someone that's like, oh, well, that's cherry picking. You're going to, what about all this other stuff? We're going to go into the terminal in a bit, and we'll look at other stuff, but I have to choose a decent enough example to show you exactly what I'm talking about. So we have our quarter points. We can see the ranging going on. We can see we have this peak formation. It's now forming a range and doing some other fun stuff, but it's at the quarter points, all right? Now we throw in the TDI, okay? Now do you notice, as I was saying, the RSI is not quite hitting overbought over extreme. The market baseline is rolling up and down over the fixed 50, okay? This was the initial rollover, okay? You can't see it right now, but this is the second leg of a larger structure. So we have our second leg of a larger structure. We get a confirmation. The fixed 50 starts to roll over. I'm starting to look for either another larger structure or potential range bounds, because the range bound typically follows after that first move away from the peak. Now we have the moving averages. The 13s cross the 50, and then we start to get the crossover, the 50 and the 200, the 50 and the 200, the 50 and the 200. What is happening here? They are consistently breaking out of certain ranges, stopping at previous ranges, breaking out of the next range, getting those moving averages to cross over and over and over. Trigger, trigger, trigger. Okay? And what you'll start to notice, I'm going to point this out more in the charts, but seeing as how I don't have a crosshair, is that a lot of times you'll get immediate pullbacks when the 50 starts to cross the 200. Why? Order gets triggered here based on a crossover, okay? Some computers, so the 50 crossed over, the 13 crossed over the 50 over the 200, buy. Okay, cool. Thanks for your order. See ya. You'll usually notice that you'll start to notice it as you go back in your charts now that, it's been pointed out. And I first realized this when one of the guys that was in the swing club, he was taking some demo trades, and he was doing some homework and taking some demo trades, and he was constantly getting stopped out. And I noticed, I said, why are you taking it so late? He was basically, it was almost inexplicable where he was taking it. And he said, he's like, oh, well, 13 crosses the 50, right? I'm in level 1, and that's my safety trade. He's a smart guy. He just got confused on the rules, okay? And that made me think for a second. I was like, wow, every single one of his trades, he took the trade when the 50 and the 13 crossed, and then shortly after, he got stopped out. So I started doing a little bit more looking at my charts, and I realized a lot of times the 1350 cross on the H1, by the way, that 513 cross, the 5200 cross, there will almost inevitably be a pullback right after that cross is over, because for the very fact that they are getting orders triggered right in this area. Cool, it's up, hit your stop, let's induce a little bit more for the actual people that can watch and trade, the actual humans, all right, and then hit the stops again, roll back over, trigger order after order after order. Now we're going to throw in those sweet spots, all right? I changed it back to gray because it's a little noisy for a lot of people for doing the presentations, but you'll notice, once again, they work the 250, 500 pip range, but they're also constantly stopping 50 pips below, or 50 pips above the quarter point, 50 pips below this next quarter point, all right? They will create ranges, they will create support and resistance, and then they will violate those. Now, when I'm looking at this chart, when I get to my computer, because I can almost hear the people, well, yeah, but doesn't Steve talk about this? But this right here, when I get to the chart and I take a look at this, and I know we're seeing the whole thing. I didn't put it on the hardware edge over here. But when I get to the chart and I start to see this kind of behavior around here, I start looking for this right around in here as I see that 1350 crossover. But what I know, looking on the H4, I'm not taking all of this stuff on the H4. Oh, this massive W and this quarter point railroad track. I'm just identifying the market cycle, the phase of the market. Oh, we're in range bound. That tells me how to trade on the H1, and we'll get into that. Okay. So again, this is real quick. What's going on and why are they doing this? Why am I rehashing what I already just said? Because Steve has been talking about this, and Carr and Jim for years, okay? And, you know, still to this day, I will get all sorts of messages on where people are just flabbergasted. Why aren't they moving? What direction are they going? I don't understand this. And that gets really frustrating to me. I understand the confusion because I was confused for a year. I used to get really ticked off. Why any more than a couple days? What the hell are they doing? I would always forget. Well, they're working the crosses, they're accumulating, they're collecting, this kind of stuff. So that's the answer. Their goal is to just accumulate, book the rapid profits, and confuse. That's it. Especially in these range bounds, they're really accumulating a lot, and they're booking a lot of profits because they're moving 250 to 500 pip ranges after they do all these false breakouts and the support resistance stuff and yada yada, hitting the trap line to the left. They're just getting people worked up. Oh, now it's going, now it's going. Because what happens every time they start doing a crossover, aside from orders getting triggered, people start seeing angle and separation. Every time that 50 starts to cross over the 200, I knew it was going up. I knew it was going down. Now I'm going to get in. All right, I just need to wait for my oscillator to cross over, and then, ooh, I'm good once it breaks that 00. Cool. Then they do it. Then the market makers go the other way. So just remember, as long as it's going, that's what they're doing. They're simply accumulating, booking rapid profits, and confusing. Simple as that. Now let's go through one at a time just to take a look really, all right, and see what they're doing. Again, I don't particularly look at this and go, ooh, I'm going to trade this. What I do is identify my areas, and then I dial down to the H1. Just like PK and Amir, they look at the H1, then down to the M1 and the M15. Well, first they dial down the M15, look for the prime areas. Then they go down to the M1 and the M5 to dial in and tighten up their entries. So that's what I do starting from the 4-hour, and then I'll dial down the. I pretty much stop at the M15. But again, this just gives me the general direction, just like the H1 gives PK and Amir and Ted the general direction for them to dial down and snipe those entries. Okay, so we're starting with this peak. Actually, first let me grab a drink of water. No Diet Coke for me. Okay, so we start off with our peak here, okay? And then it starts to cross over the 13 over the 50, and that tells me because this is a extended second leg of a larger structure, that means that's my little code for the second leg is gone below the first leg, all right? I'm starting to see that, okay, we could be going into a move back up towards the middle of the larger structure or going into consolidation or the range bound. So that's what I'm looking for. The first hit that they do after they break into this consolidation right here, this is what they'll tend to do. Hit the 50, hit the water, hit the 50, hit the water, I'm sorry, hit the mayonnaise, hit the water, hit the mayonnaise, hit the water. Now, they create this area of trapped volume down here, and the last place that people started going short was over here, okay? Because, now it's going to reject. They're hitting various areas over here on the H1 and the M15 and all sorts of stuff. But they break up, and they trap move end of week at the trapped volume over here, okay? It's a failed peak to the left over here. Look at that. How many traders probably thought this was going long? They're getting in end of the week. I'm going to catch that momentum, all right? So they induce pass here, stop just short of the 50 below the quarter point, and roll over and pin right to that 50 above that quarter point, staying off this trap volume right in here. They start to create a support area, all right? The stop up here is at your upper bands. We have now officially crossed over that fixed 50. So I'm in the mode of, all right, look at my TDI. Are we in the extreme overbought? Are we going into trend mode? The way it just stops right in here and then starts rolling over, that starts to really confirm, yeah, you know what, we're going into range bound. You can see the way they're working the moving averages. They're starting to get people excited about the moving averages and signaling systems, especially on the H1 and the M15. At this point, moving averages are crossing all over the place, okay? Where do they hit into? Right into that area. We have many confluences. It's a zone flip off of the top, the middle of this peak, 50 pips above the quarter point, trap volume at the volume body. Again, I'll cover that more in depth, but basically the volume body is the lower or upper portion of a candle that has a big old pin, okay? So here's a big pin, that would be the volume body. There's a big pin, that would be the volume body. There's a big pin, that lower portion would be the volume body. They're very important for later on, but just so you know what it is. And now we got a nice shark fin. Okay, moving forward, what happens next? More trapped volume, again, to the left, at the quarter point. Trap move end of week. Once again, same concept. Railroad tracks, classical divergence and band divergence. All right? Confluences, even on the 4-hour, looking at it, you can see like, all right, you know what, I could maybe possibly get in there. I did take that, I think, down on the H1 based off the H1 pattern. So I don't typically enter on the 4-hour, just to be clear. And once again, they shoot all the way down. You're projecting out. You have this trap area. Okay? They give you a hit into that area. They shift away. Again, you're getting to your terminal at this point. You see the moving averages up and down. You're like, all right, cool. Let me dial down to my H1. I see a multi-week W, and they roll over. They shift away. I guess would that be kind of a H4 half of that? Not really sure if Carr would consider that. But once again, right up to a previous trap area. They give us a second shoulder. And we start to see they have a head and shoulder right here as the second shoulder. We see a TDI head and shoulders at the upper bands once again. They're just up and over and up and over, creating all sorts of signals. So again, all right, false breakout. Now they get a false breakout. What do? The previous previous month, they created this range at that sweet spot. They created this level of support at that sweet spot. Finally, bam, break it. They come back in. There's a lot of trap volume in here down on this red candle, but the most important trap volume is where they broke that support. So they trickle their way down to that previous area of support, one slight pin, and they roll over. Now they stop really getting to the extremes, okay? This tends to be important for when a range bound might actually be over. all right? Because you notice pretty much this entire way, they're either creating a new extreme or coming down to a previous extreme, okay? And then they just start to stop short. Why? Bringing it in, bringing it in, bringing it in, okay? They induce a little bit past, come back. Now they're just holding that range. They tighten the range, they tighten the range, they accumulate. And what are they doing there? They're starting to wedge. And they're starting to scoop the market baseline. Do you notice the distinct difference? And the reason I'm showing you this is because I know one of the biggest questions is, well, how do I know if it's going to range, or how do I know if it's going to actually go into a trend or whatnot? Mainly the TDI. But also I can see here, well, yeah, this was a perfect rejection. This was a nice, if you're on the hard right edge, you're thinking, you know what, that's probably a good short. Or that's a confirmation because you're not entering on the 4-hour. If you're looking at the H1 and the M15 and you entered, my mouse keeps disappearing. I apologize about that. I try to click to get it to show up again. If you're on the H1 and you're looking at this and that's a nice intraday this or multi-day W or 21 trade because I got 2 legs over here and it's starting to, there's a nice H1 trap candle right there. Maybe you get in nice and early on this and you get a decent amount of pips, but then it stops. It starts to hold and then it rolls over. Well, between that and the TDI, this finally didn't hit the bands. This didn't get down to the bands. Notice this entire area, it's bands, except for the divergence here. Bands, outside of the bands, shark fin, bands. All of a sudden, yeah, not quite getting there. And then it just starts to roll over and scoop that market baseline. That can start to tell you, like, all right, you know what? We're probably not going to continue this range bound for too much longer. Because I repeat, the H4, you're looking at it, at least the way I do, to figure out how you're going to trade the H1. Okay? So with all that being said, let's take a look at the H1. Just to recap before we go back and look at the H1, the range bound on the H4 what's the word? Not equivalates. Is that even a word? Equates. There we go. Equates to the wide range swings on the H1, which is where the clear market maker cycles occur. In these range bounds, in these larger structures, you see more of the clear 3 up, 3 down kind of stuff on the H1, as opposed to the trend, which is 3 down, 3 down, 3 down, that really drives everyone nuts. Now, it should give you the confidence that they're going to move towards your projected areas. If you're looking at the H4, there's a lot of money trapped at those areas. If you have them clearly marked out the way I did, and I know we kind of went through that rather quick because I want to get to, looking at the H1 and looking at more examples in the MT4 and actually being able to, answer some questions. But when you're projecting out the way I did on those H4 slides that I showed you, if you do enough homework on the H4, you're going to realize they have to work that market participation and they have to work the system activation. Their whole business is based on it, okay? And if you're swing trading, which, that's the entire idea of the presentations, you'll be able to just identify these areas and basically be at peace with, okay, it looks like I could probably come back on Wednesday and take a look at this. And if you enter, it's like, all right, well, it's Tuesday. That was the false move week beginning. I have this lined up and that lined up. I've entered. Okay, good. It's most likely going to come up to here. Now, when I talk about trade management, that's going to be a big help to a lot of people, because what I do not recommend is just getting in at your entries and holding the entire bag. I do things a little differently, but what Jim talks about with taking 80 off and letting 20 run, the concept is the same. I scale out, and I recommend if you were really swinging, do so as well. Even if you're not going to swing, you intraday guys, try this stuff, okay? you'll be able to book some more profits if you're looking at your H4 and marking out these areas instead of just going, oh, where's my levels, and then I expect this, all right? Because I've really tried to dial this down into getting it at some of the best entries. Some of it is not comparable to, say, PK or Amir, but specifically the take profits, knowing where they're going to go to instead of, just taking the 30 or 40. So even if swing is not your bag, hey, give it a shot. Okay, I just covered that. I have a tendency to go past where I actually am at in my slides. You guys all know that by now. Okay, to the terminal. While I set this up, ask some questions. I didn't have my terminal run because it slows things down. All right, can you please, in detail, go on H4 like you're doing now, explain how to avoid open positions or setups? Not sure I understand. How to avoid or open positions or setups from 10 December 2015 to January 2016. I can take a look at that area. Okay, are there any questions so far? Anything you want to look at on the chart once it opens up? Yeah, TDI bands and closing fixed 50 again. Absolutely. That's one of the things I really want to open this terminal for. The main idea, no questions yet, don't know enough to ask them. Not sure why it's taken so long. Probably because I have everything running. No. There we go. My favorite music for trading or in general? In general, give me some good metal. While I'm trading, some jazz or classical. I really like Grant Green and some Cannonball Adderley. Okay. Blues? Absolutely. Blues. Love blues. Okay. So, again, what this tells me, going into it. Now, here's this larger structure, all right, that I was talking about. This is where we came off that peak, and they made the clear, wider structure. I call this kind of stuff the larger structure, but this is a wider structure. As I've said before, I'm not particularly fond of peak formations that last, that are only a day, like an intraday M or intraday W, okay? So I'd like to see these larger structures, especially when they're working a previous low from the previous week on Monday, Tuesday, and then shift away. Okay, so going into this, let's say I get to the market. Right here, all right? I see that they have this previous trapped area, and I see that they're trapping. So how do I handle it? I'm looking at this, I go, okay, you know what, we are in a potential trend, a new potential trend, because as I've said in the past, this is what a trend is like. Somebody asked, could I please explain the TDI, the bands closing fixed 50 again? Where's your fixed 50? Right there. Where are the bands? The bands are below the fixed 50. When you're in a consolidation, a range-bound area, notice everybody likes to focus on the market baseline and the RSI, and for good reason. There's a lot of importance in them. But they very rarely realize that, like, oh, once we move into this choppy consolidation behavior, the bands begin to enclose the fixed 50. all right, as the trend starts to get underway again, we do break the previous low, right? The bands scoop back below the fixed 50. Once we get into range bound, now see, here's going into this, it may look like, okay, you know what, a new trend might be underway, but I know enough about the market and looking at charts to realize most of the time they don't just go, 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 up, 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 especially from a low point, all right? It's easy, and most of you guys have been around for a while, it's easy for investors to get panicky and scared at a top, at the high. Yes, they get elated, they get excited, and they're buy, 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 and the market makers are just driving, driving. But it's real easy for panic to set in and for people to be dumping, and that's why with peaks to the high, what do you often see? You see, like, man, it just drops, right? But a lot of times people aren't buying after a big drop. More, they need more convincing. Okay, they're not just eager to start jumping on stuff like, oh, well, now it's going to go up, now it's going to buy. So they'll have to hold. They'll have to hold the market. So going into this, I'd say, okay, the bands are above the fixed 50. They're not in closing. It's not really chopping right now, but I'm not too concerned with that because the 50 is getting close to the mayonnaise, and that blueberry is not quite down in this area. This is that area of previous trapped volume. Now, when we get into the trends and the resets, I'm going to talk about something called the moving average tug, okay? And basically, just real quick, is they will tend to hold a level, drop price and chop price, in order to bring the moving average into the area. So think about this. Maybe a month later, this is down into this area. What potential does that give them? It gives them the potential to hit that blueberry, trigger a ton of orders, because that's where the orders start to accumulate at the blueberry, at the mayonnaise. So it gives them room to move up to the same area, but trigger a ton more orders than they previously would have been able to by, say, if they just shot it and go hit the blueberry because we want to pick up all the orders of. No, it doesn't work like that. Okay, so going in, I think potentially that is where I could be, what I could be looking at. I could be looking at some chop right here, even though the bands are now above here, and that tells me we could be looking at a longer-term trend. I also know short trend just doesn't turn into long trend immediately. You get shorter-term trends, but there's a lot of consolidation and range bound that happens before those get underway. So then I drop down to the H1, all right? So we're down to the H1. Even like right here, you can see, okay, level 1, level 2, and we get up into level 3, burst, all right? What do? They give us a reset. Now we're here. What I'm doing is I draw this stuff out. I use that knowledge of the H4, and I think this is really what you need to latch onto. I use that knowledge of the H4 just to know, hey, you know what, this is most likely going to chop. I'm not chop, but I'm most likely going to get the wider range swings, the 3 up, the 3 down. Okay? Now let's just take a look at this, knowing what we already saw on the H4, how it plays out. Okay, now do you notice that trapped volume over here? Jim doesn't talk about the D1 trap zones and all this kind of stuff just because, well, it's funny and it's fun and he wants to say it. The trap volume is very important. It's really important. Looking to the left. I love it. It's like the basis of all my analysis. Just look to the left. Okay? Now you get a little bit of a star pattern, but as you're seeing this come down in this area, what you should have is this stuff marked up. So you can see, aha, this is an area of interest. The quarter point is right there. It's at a sweet spot. This is the last place people got messed up, right? Last place they got screwed. Look at that. Oh, look, it's rejecting off the previous day's high. People are going short. They have trapped volume now here. People getting excited. It's crossing over, right? People going short. Signals getting fired. Systems getting triggered. Okay, so now we have all sorts of dreams taken away right here, and a lot of fun for us to have if we can identify the area. And then I'm not going to dial down to the M15 right now. For me to talk about the M15, there's so many other people talking about that. It's just the idea. You dial down and you fine-tune, okay? So this is the kind of the process that I want you to go through. Do some homework on this. Identify a 4-hour range-bound segment of the chart and then dial down and look at all the areas. Mark the areas first on your H4 just like I did, and then dial down to the H1 and look further and go, oh, okay, refine it, all right? Because on the H4, I might have had this because this might be the area of trap volume. But you come down to the H1 and you say, there's my trap volume. It's at the sweet spot. Write that stuff out, all right? Now let's move forward because we're getting a little backed up on time and I still got to take questions. As you can see, this more expectant of the 3 up, the 3 down, the market maker cycle. And knowing what you know now about the H4 and like, range bound, why do they do it? To induce false breakouts, to hit the sweet spots in the quarter points, to create triggers by getting the momentum oscillators to roll over and turn over and fire across the baseline, to get the crossovers happening, to get people in. This is what I'm talking about. Remember I said that they start to create the angle and separation. All the moving average crossovers on the H4, it looks like, well, yeah, there's no angle and separation. But on the H1, the M15, you start to create the angle and separation, and bam, that's when they get you. Okay? Look at that crossover right here. Oh, my God, now it's going up. Cool. That's right where we're going to take your money. End of the week, momentum's up. I want to get in before the end of the week, shore up my books. I kept thinking it was going down here, then I thought it was going to go down there. I lost, 20% of my account. Now it's going up. It's definitely going up. Let me get some money before the end of the week. All right? And then they go long here, and then they get divorced on Saturday. So that's what's going on here. And you can see, what do? They throw a false W. People go long here. Oh, it's just a pullback. People go long here. Oh, it's just a pullback. People go long here. They finally cross over the 50. Well, they did right there. Take it away. All the way back into this area. We can see the clear moves. Okay? Now here, this might be confusing to some people because, the 50 just crossed the 200. I thought that was supposed to be level 2. Where's my level 3? Well, ADR-wise, that's level 3. Now they're starting to create support. Okay? So take this as a lesson in regard to I can trade right through the moving averages on the H1 and the M15 if my H4 is in line. I just looked at my H4. The TDI is showing me that a potential range bound is happening. They're doing these aggressive, clear moves. Don't be afraid that, well, that's only a single leg because last week, I don't look at last week. It's only, 3 to 5 days. That's 7 days. What am I supposed to do? See the moves. Understand what they're triggering in the people and the systems, and don't be afraid to trade right through the moving averages because I know for years that tripped me up. And I know a lot of people, come on, let's see a show of hands. How many people have just clicked out of trades because, it's hitting the 50 and it might bounce. It's hitting this, and I thought it was going to bounce. I see that. Yeah, I'm getting some whys. So knowing your cycle, knowing where you are in the cycle, and knowing how they handle the people and the systems, that'll help you to be able to go, all right, I know what they're doing. I know where they're going. I've drawn out my trap areas. The confluence is up there. My TDI doesn't look right, so I'm going to hold on. I'm waiting for it to get up there, okay? And you can see right there, there's multiple confluences on the H4. What do we get down here? Isn't this a head and shoulders on the TDI? It's hidden right here. Second leg, baseline bounce, shift. Second leg, or safety trade, baseline shark fin, right at that 50. It amazes me every time we look at it because it's just so consistent. Okay, so let me end there, and I'll take some questions. So please, fire away. No questions. Either I just massively confused people, or you get it. You're new to the concept. Still need to learn about this. A little confused. No, Doug, I get it. It's awesome. Thank you. Yeah. For the people that are saying, yeah, a bit confused, you just take this, go to the bathroom after we're done here, and then come back and homework the stuff. Just pick one 3 to 4 month area on the chart and say, is this or is this range bound on the H4? Cool, it is. Let me go take a look at the H1. Now, before I was talking about the RSI on that H4, how it never quite hits the extremes, how it's always hitting the bands. Your bands become your extremes, the upper levels. Well, notice where it was hitting the bands on the H4, that's where you're getting the extremes over here on the H1. All the time that it was hitting the bands, down here you're getting, oh my, divergence at the extremes, okay? And you're getting real big, the market baseline is hitting the extremes. So being able to read top down, H4 down to H1, it really, really helps. I get it for now, an hour from now. Right. An hour from now, it's going to be like, what? Thank you, Glenn. Appreciate that. Doug, where on the on the 1 hour are the entries? L3 or pullback to 50? I like, look, your entries for swing trading, your entries are only the peak or the safety. I really don't care. Look, on a level 2, I started looking at that 23 trade. The level 2 is the only place I would do that is if it's setting up for a 23 trade. And actually, I think Mr. PK or Ted, if you're in here, does this qualify? This, to me, when I was looking at this, I was like, oh, this is that level 2 pulls back into level 1, kind of shift away, and that's the big move that they were talking about. I'm still new to the concept, so I don't want to say that this is one thing and it's not, but I see the zone flip. Okay, they create the 3 bursts up. Here's your second shoulder, rolls over, big move, and then just shifts back and hit the bottom of what would be level 1 or the neckline of the peak, and then it just rolls over. But level 3 and safety, that's primarily where you want to get in. I'm not going to talk about it too much, but I use pendings a lot at the previous trap area. All those little boxes that I drew, I use pendings at those trap areas. I go a little bit lighter at times, depending on, well, say I took this area. Oops, sorry. Say I took this area. Well, if I put a pending down here, I have to, seeing as how it's the sweet spot above the quarter point, I have to compensate for, well, you know, it might break down and hit that quarter point because they have created that area of support, and they might be doing a false breakout. So I might put a pending over here and then put a pending down there. But I'm not suggesting that you do that, because I know most of you that are confused are going to remain confused, because sadly a lot of you aren't going to do the homework. But if you do the homework and you learn how to just project out those strike zone boxes, as Steve used to teach, most of the time you'll accurately be able to predict where the highs are going to be, and you can get in pretty close. But I don't recommend getting in at level 2 for swing trading, because there is a setup I identify that I recognize that I personally call the level 2 nope. And to me, it's a reset that happens in level 2, and that can really screw you up. So, now the second leg baseline bounce and the safety trade baseline bounce, as happened here and here, those are some of my favorite. I almost get weepy when those happen. I just really like them. Okay, have you noticed that on the TDI that when RSI crosses 13, crosses the signal line, there's a good potential for the entry? Well, yeah, I do like, see, for the H1, it's more of a confirmation, okay? it's more of a confirmation you got it, because, for example, if you saw this 1, 2, 3, and you see some divergence, and then you get in over here because, well, it's closed over, and now we're coming back up, and, ooh, I see a second shoulder. It closed back below the 13. That's a 50-pip pullback. When we haven't gone down to the M15 because it's been covered enough, but I identify the areas. I look for the patterns. I could see this second shoulder coming this previous day. I then dial down to the M15 and follow Carr's rules and other rules on the M15. I'm not actually entering on the H1. Once in a while I do, if it's really clear, but only on a baseline bounce will I get in on the one. That's pretty much it. See, when it's range is no problem. Much problem is like the December 10 one drops so much it will trigger. Yeah, Bobby, I'm going to go over trends next week, and we're going to cover resets, some really cool concepts that aren't new. A lot of stuff has been covered by Steve before. It's just many people, I think, including myself for years, just overlooked it. And then I rediscovered this stuff for myself when doing all the homework. So homework's cool, kids. A little bit hazy now. We'll re-listen. Yeah, Phil, that's the important thing, is to re-listen, but please re-listen, take notes, and go and do the work. You know, I know I keep saying that, but it is vitally important. Just go pick a chunk and be like, hey, this looks like what he was talking about. Let me look at the TDI. Oh, look at that. The bands are enveloping the fixed 50. Cool. Let me mark out the tops and the bottoms of this range. Like, really, that's... I'm going to change the chart. Really, that's all you... I'll show you really quickly before we go, okay? Identify an area. Let's just go back. Range bound, all right? Close proximity, 250 pips. Let me just experiment. Let me just draw that out, okay? Where am I hitting? Okay, I see this is an area. I'll just draw that out. And obviously, this is an area, okay? I mark these as green since that's my long area. And then here as short, or as red, tomato, because that's my short area. Now, just simply dial, because as I said before, when the terminal, and you see, okay, a larger structure, we're going up, 13 has crossed the 50, what happened on the other one? Well, they hit the mayonnaise, they go back to the water, then they create a new range. You're seeing that, okay, the moving averages are close together, the market baseline is back up over. Let me just, I've identified my range. I've identified my potential area. I have this trap volume over here. It's stopping over here. Cool. Let me just take it down to the H1 now and nitpick. Where's the trap volume? Why did they stop here? Okay, how many people thought they were going short right here because this was a third hit to the high? That's a nice hourly shift candle. So let me draw a line. What did they do? Well, they induced. They hit this sweet spot. Isn't that 50 pips below the quarter point? That was the trap move. What else tells me I might have been able to realize this was an absolute fake move and that they were going to continue upwards? Well, okay, we're now ranging on the H1. We're at the lower bands. We get a star pattern, starts to roll over. Experiment with it. Look and see. Well, this is a great example because they hold that high over and over and over for, you know, a little bit over a week, 6 days. You can start to see the 3 up. Experiment with this. That's what I want you to do. I know it's hazy right now, but go back and just have fun with it. It should be fun anyway. All right. I've seen on the H4, then go to the H1. Right. Absolutely. And mark out your trap areas. You're to the left. I can't emphasize that enough. Your upper and lower ranges, and look at your TDI and see how they're handling, and see if it meshes with what I said. If not, send me a nice, polite critique, and I'll address your concerns. Okay, if there's not any other questions, I'm going to end it here. So type now or forever hold your peace. You betcha, Tim. Thanks for coming. Okay, that seems to be about it. I hope you all have a wonderful evening, and I will catch you study groupers on Sunday. Thank you, Lou. And for everyone else, I will catch you next week for the next installment, which I will be covering trends, resets, and all that good stuff, how to manage your trend trades. All right, so take care, everyone. Good night.